It is Thursday, November 17th, 2022. Welcome to Techtio Quick Takes. I'm your host, Alex Riley, and here are today's headlines. We're going to be talking current market and the new reality for startups. Alex Norman will explain, and we'll also touch on some recent raises that have been making news across the Canadian tech ecosystem. And Alex Norman joins me now. Hey.
Hey, Alex, it's been a while.
It has been a while. I think it was end of September was the last episode that we had. So good to be back.
Yeah, it's good to be back. I'm glad to be in Toronto, been traveling quite a bit.
Yeah.
Was thought we may have mothballed quick takes for the rest of the year, but just too much going on in the ecosystem that I thought we should have at least get one or two more in before we see Christmas.
Absolutely. It's also nice to hear that by popular demand, folks are kind of wanting us to bring it back and talk about what's happening. So on that note, let's dive in because I'm very interested to hear your take on just what this new reality for startups means. So I'm going to fire a few questions your way on this. So what do you mean by, new reality, and what is this new normal essentially?
So maybe I'll give some context here. I just spent the last 3 weeks on the road in the Valley, in New York, Montreal, and a couple other places. And I had lots of private conversations. And what became clear to me is a lot of people realize that 2022 has not been as robust or as exciting as 2021. Deals take longer to happen, valuations are down. But I don't think people, like lots of founders, have not seen the previous downturn and they don't realize what's going on. You look at the private markets and venture capital and tech, it's like a pendulum in valuations. And we hit a really high peak where multiples were high, deals were getting done fast. And then people were now probably down to a bit more closer to normal now. Mm-hmm. We were like, okay, this is going to continue. Well, what's happened is I see the momentum. And so the pendulum has to swing the other way and overcorrect. And so what's going to happen is I think 2023, you're going to see deals take longer to happen. The multiples still get compressed. And most founders haven't internalized this. And then also when stuff return to normal, it's not going to look like 2021. It's going to be more close to the middle. It'll never be in the middle. But, instead of being a 40 times multiple, SaaS will be done at 15 times multiple, or maybe 10 times. Instead of a 10 times GMV run rate for marketplace, maybe 3 or 4. And so the new reality is more like the old reality, but a bit further back than people remember.
Right. And just given all of these changes, maybe if you're a company and you're just trying to maybe figure out what your next step is, what's something that you could do to adapt to what's happened in these changes?
Well, I think the first thing to do is to really understand where you are. There's a few different variables you can look at for your company. Do you have product market fit or not? Do you have, how many months runway do you have? Do you have a scalable go-to-market? What was your last round done at, and what valuation, or what does your key KPI have to hit there? And so the first thing is being really realistic where you stand and what's going to happen, right? Because I think if you don't understand what's going on with your startup, you can't make a judgment about what to do in the future. Now, depending on where you are. So let's say you're at, in all cases, you should be looking at how you're burning and burn less. What people want to, so I think it's gone from, as everyone's heard, it's gone from a growth at all costs to what we call a growth with, with a measure of capital efficiency or metrics, right? So it's gone from telling a story about, hey, we're at 1 million this year, 10 million next year, 100 million the year after to, but we're burning money all the way through to, hey, we're going to get to 40 million in year 3, but we're going to have strong unit economics. We can highly predict that this is high quality revenue. So first of all, understand where you are. Second of all, understand how the stories change. It's not just growth. It's like we can be capital efficient. We're creating a business that will eventually be venture scale, will have be cash flow positive, and here's why. And I think based on where you stand on all these things, so if you just raise a massive round and you don't have product market fit, you need a cut. You need I'd say, and again, it's not for everyone. I think if you have product market fit, you have a scalable go-to-market, you have 24 months runway, you may actually want to be aggressive and growing and actually taking advantage of weakness in the market to grow faster, get talent, acquire other customers. And, because if you're in a sweet spot and you don't have a huge valuation overhang, grow fast. Don't change anything, but be efficient. Everyone else has to be more efficient. And it depends on if you don't have product market fit, you should only have people that build a product or sell a product. If you have product market fit, but not a repeatable sales process, or you have a valuation overhang, you might want to raise more money to grow into that valuation or run more experiments. So it really depends on the situation, but the mindset's different. It's not, you have to really figure out where you can get the best return on learning or return on investment from what activities you invest in.
Right. And you just touched on, you mentioned customers briefly, what you were saying. So I want to shift the focus to, should somebody be focused on, bringing in new customers, or should the focus just clearly be expanding revenue with the current, product market fit and customer base that you do have? Like, how should someone go about that?
So, again, I assume this means you have some signs of product market fit.
Yeah.
Right. And then the question then is, from a risk perspective, like if you're going to be cash flow positive, I think this question doesn't really matter. But if you are not cash flow positive, you need to raise money. The question is, in your perspective of yourself or your investors, what will de-risk the business? And this also assumes you can't do both. So, for example, if your unit economics are in question, and you can go get more revenue from those current customers, which improves your margins, improves unit economics, that might be where you spend a bit of time. Because then, from a risk perspective, you're not showing, okay, we actually can get cash flow. The other thing that, flip side is, if your investors are saying, hey, we don't really know if you have a go-to-market strategy that works, we don't believe there's a huge, massive market, you may want to go and prove out that you have a go-to-market that has a quick payback period, that has strong economics, and if there's a massive market here. And then you can also go, when you go raise, say, hey, we can also know that we've started testing, or we believe that we can take customer value from 20,000 a year to 50,000. So it really depends. What's the bigger risk, and which one can you eliminate? Yeah.
Right. And we've talked about this before, not just today, but obviously the funding environment looks really different. So how do you adjust your plans, given, the current economy and what all that looks like?
Again, if you have a valuation you have to grow into, cut your run rate to grow into that run rate. The tricky thing here is, what a lot of people are saying, get to cash flow positive, get to better economics. You have to still grow. So the question is, what do you do to grow? What do you do to be capital efficient? And so, as I said before, it's probably narrow down the team to people that can sell and build, and then put X, if we're going to spend X, is where you get the highest return on either growth or improving your margins.
And I really like sort of the direction that we're going in with this question, because you might have an answer that people aren't expecting, but who specifically could help a founding team maybe just level up and bring something extra to the table?
So what's interesting is, the best way to level up is to have the right team.
Yeah.
Most people aren't necessarily hiring a team, especially based on the last answers. So there's most founders look for, let's call them coaches or therapists, or people that can be outside advisors that they can be frank with and get a lot of feedback. Really helpful in a time that's difficult, really helpful when things are going well. The challenge right now is the best coaches in the business seem to have a full calendar. I can name a couple in Toronto. I've called them for some of my founders, and they're like, yeah, Alex, just not taking on any more clients. So you can look for that and work your network. Or the other alternative here is get a peer group. Get 6 other founders or 5 other founders that are similar stage as you, maybe slightly ahead, slightly behind, and face similar challenges, and get together once a month and have build the confidence to be really open and learn how someone else is tackling challenges you face.
Right. We also mentioned this too, when it comes to raising, that timing is everything. So what is this, right time to raise? If you have the ability to take more money now, how much should you be taking? At what valuation? What do you think?
So again, depends on the situation. Generally, if you don't have product market fit and you can raise more money at a similar valuation than last time, and you extend your runway by 6 to 12 months, have a minimum of 24, 36 months, I'd advise doing that. If you have product market fit, it depends how quick you're growing, what your last valuation is. But generally, most people should be, if they have an opportunity to top up their balance sheet, get to 24, 36 months runway, it's advisable, unless you're going extremely fast, and some companies will be able to raise no matter what, as we'll see later on in this conversation.
Right. And just to fire off a couple more, because I know we want to talk about some other news as well, but what revenue run rate do you have to hit for your next round?
So I actually think this is the wrong question right now in the market. And every founder goes, okay, I've raised my last round.
Okay.
We were at 1 million run rate. We raised at, let's call 50. So if I want to raise 100 million, what do I have to raise next? So there is a quantity number you have to hit, but what's changed is the quality of that number.
Right. And obviously there's been a hot topic around just like hiring and tech talent and the shift we've seen. Obviously engineers being really in demand. So are they getting, in your opinion, easier or cheaper to hire?
Not yet.
Not yet.
You know, so let's see what's going on in the market. You're hearing large, big layoffs at Twitter. You're hearing big layoffs at Facebook and lots of late stage companies, partially because they have to announce it. And but if I were to guess, a lot of the people they're hiring, again, firing, just like the previous advice, is not engineers and probably not salespeople. Okay. Second of all, sometimes there's some fat to cut, so maybe it's not the people that you want to hire. And third thing is, if you've just been working for 4 years really hard, you might, lots of these, people might want to take a time, reassess where they want to go. And then lots of startup founders like, oh, I'm going to hire them. Shopify is paying them $250. I'll pay them $175 in shares. It's very hard for someone to say, I'm going to take 20%, 30% less than I was getting paid before. And finally, there's still a lot of companies hiring. So there was too much demand before. Now it's probably getting more right size. So the market dynamics have improved for founders, but it hasn't swung the other way.
Right. So not quite yet, but soon. And just lastly, maybe to tie a bow around all of it, any just final takeaways on all of this?
I'd say, we just had 2 years that sucked, especially in Canada, for being stuck at home. But you were in easy mode of the game of building a startup. And there's no such, it's never easy, but being able to get capital, being able to focus on one metric, which was growth, made it relatively easy. We're now getting into a harder period. So I think the key thing you need to do is constantly assess where your business is at and what the market is, and prepare, plan for today, but also prepare for the next 24 months. And so it's going to be a difficult time, but I think the difficult times where we build great businesses, I think less emphasis on continuously raising money will actually end up with founders owning more of their company and potentially have more upside. But I also build a support network to get through it.
Awesome. Okay. I think those are some great takeaways. And before we touch on some of the rounds that were making news recently, I do want to mention that another great place that you can find out more information about content, information, rounds, anything like this is our 3 times weekly newsletter. You can subscribe at techtio.org/newsletter. We also feature jobs, companies that are hiring. We profile speakers for upcoming events. Just a really great resource if you're wanting to keep up with what's happening in tech. So definitely subscribe if you haven't already. Next up, there's a few rounds that we want to go over. Let's maybe start with, because there's Hopper, Xanadu, Touch Bistro, and Adibotics that we want to touch on. So let's go with Hopper first. How did this come together, and what are the takeaways from this?
Well, I think, first of all, look, we just said it's going to be a difficult time. Now we've got these 4 massive brands we're going to talk about.
Yeah.
So this is also a big difference from 2021. 2001. The public markets were financing most growth, and they shut down and moved on to value investing. Right now, the private markets still have a lot of capital. They're just going to be very careful on how to invest. But if you have a great business, you can raise. So let's talk about Hopper.
Yeah.
They just raised $96 million at a over $5 billion valuation, both USD, from Capital One. Capital One is a strategic partner. What's interesting here is, I think what you're investing is a company has grown extremely fast. I think they said their revenue is up 25 times since 2019. So, you're talking about a 3-year period and they've 25x revenue. And the nature of revenue has gone to a less competitive space. They're focused a lot on financial products, hey, you can lock this price in. They're got distribution through B2B plays, like Hopper powers Capital One's travel options. So, and they're booking $4.5 billion of revenue and travel and fintech products this year. So this looks like, hey, I just said it's hard to raise, but you've got a company that's basically raising it, just a bit over 1x revenue, has grown 25x, is differentiated from the players that they compete with. It's more than just travel bookings. It's a fintech product, which probably has better margins, and it's a distribution advantage where they're doing B2B projects which gets them volume. So
Right.
here's a company that's scaled in a unique way in a massive market, and they're getting rewarded for it.
Do you have any like final takeaways maybe on that for anyone listening?
This is one of the better, actually two of the stories here are one's a comeback and this is a pivot. I'd say this has been one of the more interesting pivots because if you go into like 2020,
Yeah.
man, the consumers are just slamming Hopper and they've built up distribution, they built up the product, it shows that, if you grow correctly, you can create value and your partners and your consumers will love you.
Absolutely. Let's do a Xanadu now. So the news there, and then just maybe some final takeaways for our listeners.
So, first of all, Xanadu, just for context, is building, it's just as much as a research project as a company right now. They're building quantum computers. They're newly minted a unicorn. I don't know if anyone uses that word anymore, but they raised 100 million USD, led by Georgian partners at a $1 billion valuation. What's interesting here, this is almost a very different story here.
Right.
They don't have revenue, at least if it is, it's nominal. What Georgian's investing in is a scientific breakthrough. Xanadu last year was able to deliver a result beyond the reach of a conventional computer system. So they actually proven that they can make quantum work. Like, I think they were able to do, what's the example here? They were a series of numbers with a specified range of probability in 36 millionths of a second, an operation that would have taken the world's most powerful supercomputer more than 9,000 years match. Okay, so
Unreal.
magnitude more powerful than your traditional computers. So what you get raising here? They were able to command $1 billion valuation because they seem to have a leading position in quantum computers that, if quantum pays off, is a relatively blue ocean space with billions and billions in dollars of revenue potential. And this money will last them through 2026. So they've now prepared for the worst of winters. They give them 4 years to start going from a science project to hopefully a real business. And there's a huge, vast upside here. So like Georgian's looking probably for a 10 to 20x return on their money.
Another big one that I also want to talk about is Touch Bistro. So takeaway is what this means. Why is it interesting?
So 150 million Canadian financed now. Again, everyone's being financed by different players. This one by a private equity firm called Francisco Partners. So less venture capital growth. The money is being used for strategic M&A. The company is as sort of a comeback story. They went through COVID. Their customers were dormant. They came back out of it saying, hey, we're readjusting, focusing on more upscale S&B restaurants. Seems to be going well. They talk about growth of 30%, not exponential growth. So like we talked about with Hopper.
Yep.
And they talk about this raise was being able to done because they're capital efficient. There's still growth to be done. They're going to do M&A. So there's a bit more private equity play. And what's interesting, they actually explicitly say, hey, we're focused on being financially disciplined and we're not hiring much. Xanadu didn't mention hiring. Hopper said we're not hiring, but they didn't say we're hiring, which is also a huge change from like 9 months ago. Everyone would say, okay, we're now going from X number of employees to Y number of employees with this money. That's not the story anywhere here.
Right. Yeah, we've definitely seen a shift, I find, in sort of what that's going towards. Lastly, Adibotics, and I'm also hoping you can explain to people just maybe the technology there and what they introduce. It's just very unique and complex.
So let again, it's when we flip from two more traditional proven business, Touch Bistro, SaaS for a big vertical, SaaS for restaurants in this case, with also payments, and then a travel site with actually payments again, to Xanadu, which is a research, and Adibotics, I'd say, is a bit more, is still has historically been research, but they now have a product out of the market. So what they do is like, have you ever seen have you ever ordered from Amazon?
Too much.
Okay, so I'm sure you've seen pictures of what a warehouse at Amazon looks like.
Yes, yeah, absolutely.
And they're considered cutting edge, but they have humans, they have robots. It's all these roads, it's all the space, and it takes a lot of people, a lot of space. It's hard to do it.
A lot of moving parts.
And it's hard to do it in a dense area. What Adibotics is doing is building a whole system to basically allow, let's call it the packing and picking, and to be done all by machines in a much more dense space and a different layout. So their system, which they just launched, I think it's called Adibot Robot. They call it first 3D robotic supply chain system for modern commerce. What it basically does is takes all that space, compresses it, because you don't have any humans, so you don't need the rows, you don't need the aisles, and then the robots just do their magic and pull stuff out, so you can get that. You get your item into your Amazon box, or hopefully not Amazon, because we need more competitors than Amazon. So they raise a lot of money now. They're based in Calgary. They just raised 95 million more Canadian from the Export Development Bank, Canada, and Ontario Teachers, to now basically commercialize what they put in the market.
And just lastly, like as a whole, I mean, I think it's great that we have so much like raises that we're able to talk about. Because I know we have been seeing things be a little bit quiet like in the past. So do you have any just takeaways all collectively from all this news, or anything in particular you want to touch on one more time?
Well, again, this is not 2001. There's still financings available. We've talked about 4 massive raises right now.
Yeah.
All can show that there's a huge market opportunity behind them. All, if they can show that basically they have strong margins, and all of them are talking about capital efficiency. So, compare this to a year ago, where if you had the momentum, you necessarily wouldn't have to prove that there was a big market. There'd be assumed to be a big market. Less worry about the competitive landscape and the ability to create cash flow, and everyone was taking the money and plowing it back into employees.
Right. Okay. Well, I think it's exciting nonetheless. They're massive rounds, obviously, that we're talking about. So it's great. Thanks, Alex, for breaking all of that down. Before we go, I want to highlight some upcoming events that we have at TechTO for our community. So next week, November 21st, we're at 111 for another edition of Tech Together. Content, again, top notch. If you've been to our recent events at 111, the conversations are just truly empowering. Is there anything you want to maybe call out for that one?
We have we're going to be doing Q&A with Carol from Axonify and one of
Lindsay as well.
Yeah, Lindsay from Nudge. So what's interesting here is it's not often you can talk to a company, the acquirer and acquiree for a few months after a deal is done. Yeah. So we're going to go into how do M&A deals get done? What does it mean for the acquirer? What does it mean for the company that was acquired? So I think both these founders are amazing, and there'll be some great insights there.
Yeah, and I obviously love female driven panels. I think it's great, and I know the content's gonna be amazing. And then the second one, December 5th, also at 111. Anything that you want to highlight from that one too?
I like the Q&A conversations. We have Stuart Lombard, who built Ecobee, sold it. Amazing journey. Started off as a VC and then a founder. And I imagine there's lots of Ecobee alumni in this ecosystem. So looking forward to learning more about his journey.
Absolutely. So tickets available for that on our website, techto.org, under IRL events. I'll link it in the show notes as well. Alex, thank you so much, as always, for breaking down the news for us. And thank you to everyone who joined us today. Don't forget to like and subscribe wherever you're watching or listening to this podcast. You can also catch up on past episodes wherever you get your podcasts. And until then, we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.